Good morning and welcome to THUB Capital, THE Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to THUB Capital's THE Investors Lounge weekly podcast. Today's date is the 29th of September. Let's dive into the week's top market news. European markets navigate mixed economic signals and central bank moves. European stock markets, last week, showed a mixed performance as investors weighed interest rate policies and renewed trade tensions. In local currency terms, the Pan-European Stocks Europe 600 index ended the period with little change. However, several major national stock indexes posted gains. Italy's FTSE MIB rose by 0.79%, Germany's DAX increased by 0.42%, and France's CAC 40 index saw a modest addition of 0.22%. In the United Kingdom, the FTSE 100 index tacked on 0.74%. Recent purchasing managers' surveys indicated that the Eurozone economy continued its modest growth pace in the third quarter. An early reading showed the HCOB Flash Eurozone Composite PMI Output Index climbing to a 16-month high of 51.2 in September, up from 51.0 in August, with a reading above 50 signifying an expansion in activity. The overall increase was driven by the services sector, where activity grew at its fastest pace this year, while manufacturing output expanded more slowly. Despite this growth, overall business confidence dipped to a 4-month low due to weaker optimism in the manufacturing sector. In contrast, business activity in the UK slowed sharply, with its PMI falling to 51.0 from a 12-month high of 53.5 in August. Both the services and manufacturing sectors experienced a slowdown, with manufacturing output declining at its fastest rate since March, partly due to disruptions in the auto industry. In Germany, confidence surveys presented a divided picture. Data from the IFO Institute revealed that German business sentiment suffered an unexpectedly sharp drop as economic pessimism took hold. However, a separate survey by the GfK Market Research Institute and the Nuremberg Institute for Market Decisions suggested that consumer confidence was somewhat less pessimistic heading into October, supported by households' improved views of their personal incomes. Regarding monetary policy, Sweden's Riksbank lowered its key policy rate by 0.25 percentage point to 1.75% in a move to support economic growth. This was the central bank's third rate cut this year, bringing rates to their lowest level since 2022 and potentially concluding the current rate-cutting cycle. Meanwhile, the Swiss National Bank SNB decided to keep its key interest rate on hold at 0%, as expected. The SNB noted that inflation, currently at 0.2%, has returned to its target range of 0% to 2%, alleviating concerns over deflation. Now our insight into alternative markets. Beyond the clutter, identifying private equity opportunities in orbital sustainability. The space economy is undergoing a radical transformation. With thousands of new satellites being launched each year, the once vast expanse of low Earth orbit LEO is rapidly becoming a crowded domain where broadband constellations, defense platforms, and sovereign payloads compete for position. This congestion is turning orbital debris mitigation from a niche regulatory concern into a primary risk affecting commercial viability and long-term access to space. For savvy investors, this challenge represents a significant market signal, creating a new frontier for private equity investment in the essential infrastructure of orbital sustainability. While current regulations and responsible practices by major players like SpaceX and Amazon have so far averted disaster, these policies were designed to prevent catastrophe, not to actively manage the complex, crowded, and geopolitically volatile space ecosystem of today. The next phase of orbital management requires a move beyond static rules toward dynamic solutions, creating clear opportunities for private sector innovation. The misalignment on debris and traffic management frameworks between the US and other major space actors like China, Russia, and India further underscores the demand for robust, commercially driven solutions that can operate globally. This regulatory and geopolitical friction is precisely the environment where private capital can fund and scale the technologies that will define the future of space operations. An investment thesis can be built around the core operational needs of any entity operating in space. In a congested LEO, the ability to maneuver and avoid collisions is no longer optional. This creates a primary market for companies developing advanced, cost-effective propulsion systems that offer satellite operators flexibility. Propulsion allows satellites to fly at higher, more optimal altitudes, extending mission life and ensuring safe, controlled deorbiting, fundamentally altering the return on investment calculation for a mission. Similarly, technologies that enable constant situational awareness and automated conjunction planning are critical. The future of space will not be run by scrambling in real time to JSPOC warnings, but by integrated systems that treat collision avoidance as an inevitable and manageable part of operations. Beyond this foundational layer, significant value creation opportunities exist in advanced services and dual-use technologies. Remote sensing, inter-satellite communication links, and enhanced situational awareness systems are evolving from optional add-ons to strategic differentiators that build operational resilience. For example, the absurd regulatory hurdles preventing the use of standard Wi-Fi in space highlight a gap that, once filled, will unlock more efficient rendezvous, proximity operations, and debris avoidance. Furthermore, as national security becomes intertwined with commercial space, companies that design systems hardened against interference or other threats will attract premium government contracts from entities like the US Space Force. These long-term, resilient revenue streams are particularly attractive from a private equity perspective. The orbital debris problem will not manifest as a single explosive event, but as a creeping degradation of the space environment, steadily increasing operational costs and risks for unprepared operators. The companies that will dominate the next decade are those that integrate orbital sustainability directly into their business models. This inevitable shift creates a fertile ground for investors to fund the essential picks and shovels of the modern space economy. For private equity, the time to act is now to identify, invest in, and scale the companies providing the critical solutions that will ensure the space environment remains a viable and profitable domain for generations to come.
Thank you for listening to this episode of HUB Capital, THE Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode, and share it with your friends and colleagues who might be interested. To learn more about THUB Capital and our activities, visit our website, thubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the THUB Capital team.